to the weekly stock market update. And as ever, we have got a jam-packed session for you. So let me know if it's your first time on here. And also, you are about to see some really impressive content. So I've got the data already and fired up. I just need to hear if you can see and hear me loud and clear for this weekly stock market update. Interesting times. I'll tell you something that my son has got into as well. And just before I do that, let's share the screen and be absolutely good to go. Here we go. Right. And right, you should be able now to see. Great. Hi, Peter. Sorry it's so early for you in New Zealand. We've got the Midlands in the room. Everyone can hear me loud and clear. Cardiff and so on and so forth. So thank you all for being here today. One of the other things I want to do alongside this is, as I do each week, is just put a little poll up and then share the results with you in terms of, in this case, the FTSE, and we'll take it from there for other things as well. So you should be able to see that screen. Let's move on to the first slide. First thing I want to show is, there's a lot of people who are starting to get a little bit antsy, like, oh, should I get in? Should I not get in? It's a good reminder. Look, when you've got a process, it is the best and easiest way to invest, whether you're Warren Buffett or anybody else. There generally is a process that people will often have. And that process should, to a large extent, of course, also be based on your risk profile. When you move away from this process, you start gambling, because what you start doing is thinking that the stock market is predetermined and somebody with enough information will be able to tell you what the certain outcome is. This is the kind of the stock market as, let's go to an astrologer. Okay, well, actually, your investor profile is going to be one of these four things. And there's pros and cons. Feel free to take a photo of this if you wish. There's advantages and drawbacks to each of this. Now, at the moment, personally, I happen to be here because of my age and my desire to preserve wealth because of my age. And so I'm more over here. There might be times when I'm here, such as 2023, 2024. But at the moment, I'm not here. And you can see the drawbacks for each one. Like I said, feel free to take a picture. The reason for processes is it, first of all, removes indecision, it removes confusion, it saves you a hell of a lot of time. Now, if I knew what the future held, or if anybody did, other than statistically, we know that quality companies tend to go up, and I'll mention what those are over a long period of time, or even an index like the S&P 500 tends to go up over a period of time, then we know what to do, okay? The other thing to remember is risk and rewards. If we take that as reward and we take this as, that's RE, and we take that as risk and we take this as time. Okay, if you elongate time, so you give yourself more time in a quality company, you're actually reducing risk of loss. Okay, if you give yourself 1 second in a good company, whether you make money or not is a coin toss. Give yourself long enough in a good company. So what's a good company? I'll come to that. Then you reduce the risk of loss. It's as simple as that, right? That interaction is what private investors often get wrong. What they want to do is make the most amount of money, which is guaranteed in the shortest space of time. And that's where the casino comes in. And they treat the stock market like casino, they speculate, and they lose money, and they get confused, and they don't have a clue what on earth they're doing. So part of my job is to give people simple processes to avoid that problem. In due course, during the course of this, I'll show you another process that we use. We simply look at companies based on valuation, growth, and income, and I rate those here because I've got 10,000 companies I need to go through because I only want the best 200 who want to manage my portfolio and pension. Each company is a CV of individuals who want to manage my pension and my child's inheritance, and therefore I want to go through 10,000 CVs. And we know, common sense will tell us, but actually from academic research, we know that undervalued companies tend to do better than overvalued ones. There's science and for you. And growing companies tend to do better than ones which aren't growing, tend to, but are not guaranteed to, and there are exceptions to the rule, So on the whole, we want to find companies which are both undervalued and growing and produce some dividend deals. And we know we want to weigh value over growth more. We also know that if we put all of these green, that there's a greater probability of having a winning company, i.e. one which gives us our returns, than one which isn't. So what are these factors? Cash return on capital invested comes from Goldman Sachs Wealth Management, just means companies that generate a lot of cash cows. Okay, their research shows, just use a bit of science. You look at the historic data, look at the research, and their research shows companies generating cash tend to do better than ones which aren't generating a lot of cash. Now you might say, oh, bloody hell, Alpesh, are you kidding me? They pay the big bucks to Goldman Sachs for working that out? Yeah, common sense would tell you that. Fine. Momentum, Sortino is ones which have just consistently performed well. Now we want all of these to be green, which is what happens down here. Now the reason, and none of these meet my criteria, the reason speculation and gambling happens in the stock market is, see all these other companies. Well, myself and Warren Buffett don't invest in all of these other companies. We invest in very, very few. He has his metrics, I have mine. There's a lot of overlap. But regardless of that, see all of these, none of them fit his criteria or mine. We're very picky. Funny thing about people who want to make money from the stock market, they tend to be incredibly picky. Retail clients, they'll pick any old rubbish. Okay. The other thing I want to get across to you is twofold. It's this. Okay, again, take a photo of this if you wish. You can either, when it comes to investing, go down this side, which is a bit closer to trading, but not quite, and I'll explain what it is, or this route. The second route, call it B, is probably a little bit safer than A. Well, not probably, it's definitely safer than A. So let's look at A first, and then I'm going to tell you what the stock market's doing at the moment and what's going on. This is where I identify quality companies based on undervalued, growing, and income. Sometimes, can you believe it? I have actually got to explain and justify to people why an undervalued company which is growing and producing dividend yields might perform better than one which isn't doing any of those things, all other things being equal. Okay, so you start off with that, and you've got a good uptrend in your favor as well. Again, not guaranteed to work, and you confirm that side of the momentum as well as value, growth, income. So you've got the fundamentals, you've got some price trends on your side, okay? And you might put a stop loss in there. You make sure you only put a little bit of money, so if your stop loss is hit, you don't lose too much money, okay? And you project forward that trend, and you make sure that the projected forward over 12 months will give you at least twice the reasonable stop loss, and that the gain would at least be 40% to the upside, say 20% stop loss to the downside. That's still rather risky. It's more a momentum-based trade, 2-to-1 reward to risk. Make sure there's not so much money that you lose more than 1%. Now that gets a bit complicated for a lot of people, and they don't want to do that, and that's perfectly fine. And here I've shown the sort of pros and cons and profile. Therefore, what might be easier for a lot of people, but they lack the patience of this. And the reason people mess up, even if you give them the goose that lays the golden egg in the stock market, there's only two reasons they mess up. One is boredom, the other one is panic. Boredom is where they say, oh, it's taking too long, I haven't got my money quick enough. And panic is when it moves in the wrong way too quickly for them. Okay, those are the only two reasons they F up good investments. So let's say again with this, you start with quality companies, and we'll come to that in just a second. And with that, you can start a bit small. You might buy 1%, 2%, 3%, whatever. Let's say the price then falls. Well, if it falls and the company's still fundamentally sound, as often happens, this is the bit Warren Buffett loves, when they fall, but it's still a good company, then you can start buying more of it. Okay, this is the dip buying. Why would you do that? Well, you know it's a good quality company, and so the Warren Buffett approach, you just keep buying more at a lower price. You average down, your average cost of acquisition drops. You make sure you don't end up owning too much in your portfolio of one stock, so you don't get too concentrated. Okay, that's the easier way of doing things. But both of these require it to be a quality company. If you want to gamble, speculate, then go play with the 900 other companies which are pretty rubbish, go up and are extremely volatile, because they're there and they're always in front of you, and they're the noise in the market. They are the constant headline grabbers, and you can go speculate with those, just as you can go to the casino and listen. If you're really good at blackjack, you might want to stick to blackjack, but you get tempted away and start playing roulette instead, or baccarat, or something else instead. Well, guess what's going to happen? You're going to start losing. So if you want to go and speculate because you get tempted away by all the shiny little things, like, I don't know, cryptocurrency and trading, spread betting for 5-second holds or binary bets, go ahead. There's lots of shiny little things to take your money. But essentially, you probably want to look at A or B. Now, which one's better? Well, probably for most private clients, B, but A is something they can evolve into and they can be a bit more sophisticated, a bit choosier. The fact of the matter is, Warren Buffett talks about doing B all the time, but in actual fact, as we all know, he actually goes in and out of bits of his portfolio. So he does a mixture of A and B. He doesn't, he doesn't just hold this portfolio forever. Some of it he does, like Coca-Cola, but Apple is more this. All right, so we're going to do a bit more about this. Richard, no worries at all. Welcome to everybody else on here. We've got Clovis, Paul, Chris, David, and everyone else. So welcome one and all. So feel free to take a picture of that. And now I'm going to put some bones to it because, like I said, if you want to save time, you do processes. And I've written about this in my various books, and I'll make sure you got a copy of those. And I've written about bits of this in my Financial Times columns anyway. Now, this one I created a few weeks ago because, a picture paints 1,000 words. Where are we at the moment? So this is the S&P, in case you're wondering what it is, and each one of these bars is 1 week. Okay, we are here. We're at 0.4. All right, we're here. That's 0.4. When we get to something which looks vaguely like 5, i.e. this starts moving up again, and the weekly momentum. And in case you're wondering, what are these lines here? These are just short and medium term prices, okay? Average prices over the short and medium term. And when they tend to rise, the prices of the stock moves. Now you might say, well, wait a minute, is this just some voodoo? You're looking at charts, like an astrologer might. No, well, I'm not. I'm actually looking at prices. Prices are probably the closest thing you'll get to truth about what people think, because when people are willing to buy and sell, tells you where they're putting their money where their mouth is. So it's at 4. Now, if you are a bit risk loving, you might get in when you get a pattern like a 5. This moves up, this starts flattening. If you're a bit more risk averse, medium risk, you might wait for a 6, and a 7 is when you're a bit more risk averse. And you can see what happened in 2003 if you did that. We didn't pick the bottom of the market in 2022. We were in cash for all of 2022 because 3 and 4 had happened. It basically moved below. And we got in late. We tend to get in late. We tend to get out late. We'd rather be late than early. And we never call tops and bottoms because we don't have a crystal ball, just so you know. And I've said this many times before, whilst I have a master's degree in politics and economics and a bachelor's degree in law, none of that helps read Donald Trump's mind, to state the obvious. Now's a good time to be able to state the obvious. So other times when you say that, people go, no, you're just kidding. You must be able to see the future. It just takes awfully clever people. No, that's called marketing, which is what fund management companies do and wealth managers do. So, he's an awfully clever person. He's been to all the right universities, and therefore he knows as a fund manager exactly what's going to happen in the future. Absolute bullshit, okay? Because I can tell you with this, what's going to happen in the next 5 minutes with that stock? Don't know. What's going to happen over the next 2 years, 3 years? Probably got a good idea. If all this was green, I'd have a pretty good idea which direction it's going to go in. Okay? So let's have a look at where we are in the market. By the way, for my clients, I always tell them to work out their persona. And a lot of them end up here, and we get some model portfolios for them where the volatility is kept to similar to the S&P. 18% volatility, you should be looking to get about a 30%, well, 25 to 30% return per annum. Not every year. This is what confuses people. Okay, over a 5-year period, historically, that's what that portfolio should have achieved. If it achieves it again in the next 5 years, then it achieves it again. There's no guarantee it will, but that's historically what 18% should be doing with companies which are undervalued, high growth, dividend yielding. Can it do it pro rata for the next 5 minutes? Or, it's been a year. So can it do one year out of, can it do a fifth, if you're holding for 5 years, of that in 1 year? Will it guarantee me 30% per annum? No. Okay, when people don't understand how statistics work, a bit like a coin toss. If you get a coin toss and I say to you, toss it once, and you go, oh, it came up tails, so it must be a weird coin, it's not working properly. No, if I said to you, toss it 100 times, I guarantee you won't get 50 heads and 50 tails. I guarantee you won't, but you'll get something close to it. okay? And it's the same with portfolios. The longer the time frame, the closer it'll get to its average return, but guaranteed it won't be the average return, right? Sometimes people find that a bit difficult to understand. Anyway, so let's talk individual stocks and where we are on the stock market. But I just wanted to sort of explain that to people of where we are and what you should be looking at. And if you want to know what an 18% volatility is, let's put some numbers to that. That's the S&P 500. Okay, it's the 500 largest US companies. That's what the volatility of that is. If you want to know what 15% per annum return is, that's doubling your money in 5 years. That's the longer term historical return of the S&P. Okay, 30% is doubling in about 3 years. So you might say, well, wait a minute, why should I try and get such a higher return given that it only makes a year or two difference of doubling? Exactly. You might as well just say, thanks very much, Alpesh. I'll leave the webinar now. I'll get my S&P 500 average long-term return, 15%. I'll take it. That's in sterling terms over the last, 15 years. It doesn't mean it's ever going to happen again. We might have hit the peak, all-time peak of stocks, and any of them ever go up ever again after tonight. Again, to make the point, the difference between probability and guarantee. Guarantee is 100%. Probability is a number below 100%. Okay, there is no guarantee of the future. There is no guarantee the sun will rise tomorrow, regardless of what that girl sings. The sun will rise tomorrow. Nope, there's no guarantee it will. Now, where are we on valuations? You're paying $26 for every future dollar of profit of Microsoft. When you buy a stock of Microsoft, when you buy $100 worth of Microsoft, for every dollar you're spending to buy that stock, you're paying you're effectively paying $26 for every $1 of profit, future expected profit. But then Nvidia, you're only paying $19, so that's cheaper. Okay, think of it as rental properties. You're getting, for every $1 of rent you're having to pay $26 to buy that property. Whereas here, you only have to pay $19 to buy that property. And you might say, well, bloody hell, why would I just not buy a load of Nvidia? In fact, forget that, Alpesh. What's this? JP Morgan, 12, Bank of America, 9, Citigroup, 7. Well, because valuation isn't the only factor that's important. This is just a measure of valuation. What about growth? That's why people pay more for Apple than they do for Citigroup. Because guess what? Apple is expected to grow more than Citigroup. However, we do want to take into account that valuation is important. So we will look at those greens, and ideally if we get a stock which ticks the value, the growth, and the income boxes, i.e. all of these, won't we be that much happier because it ticks all those boxes? Okay, if it ticks all those boxes, we're incredibly happy because it means we're less likely to have done something stupid. It doesn't guarantee we're going to make lots of money. What it means is we get a good night's sleep because we haven't left something obvious to chance. Ideally, certainly in markets like this, which are more volatile, I also want that to be below 1. Why are these factors the most important? Well, we looked at the research from, and I've written about it in my books, 3 economists in particular, Daniel Kahneman, Richard Taylor, and Eugene Fama. They all went on to win the Nobel Prize in Economics, and I'd written about them and their research before they won those prizes and published it in my books because I said I think they're doing amazing research on what moves stock prices, and in fact they were, and people's behavior to it. So that's why we come up with value, growth, income, amongst the other stuff. And if you want to read where some of that stuff is, if you go to alpeshpatel.com/shares, you'll see some free articles on there. /shares, you'll see some free articles here on what moves markets and so on. Okay, so as well. So let's get into some of the nitty gritty. We've got earnings coming after market close. AMC. We've got today Microsoft and Meta. Okay, we've got Qualcomm. Now all of these are going to be important. I don't gamble on earnings, right? I don't gamble on earnings, so I'm not about to buy in front of it. When I was doing my Bloomberg TV show, we would love days like this. Oh, we're all excited, lots of drama. Well, that gets eyeballs onto TV. Of course, there's going to be lots of drama. But the reality is, if you want to reduce your time frame, you're increasing your volatility and risk, which means you're more likely to behave like a gambler. Right? Oh, what do you think the earnings are going to be? Do you think they're going to be positive? It makes for great TV. It's great for billions. It's great for industry. What are the numbers? What's the number that's going to come? It makes you look really and feel really sexy. Okay, very Wolf of Wall Street. I'm sorry, you're more like a Warren Buffett if you're investing in your pension. You're more like a 95-year-old man, okay, who's pretty bloody dull. And that's the way you want to keep it for your pension. Your pension should be bloody boring, not trying to all be heroic TV characters. You're not the Tom Cruise of trading, right? and neither do you want to be when it comes to your pension. So when we come to these, look, let's say the numbers are really great in Microsoft and it pops upwards. So be it. We're not trading here, and we're not talking about trading here. No matter how much people want to distract you, and they'll try, and certainly on social media, oh, no, let's talk about trading. If we want to talk about trading, we'll do that separately. Okay, and I've written enough books on trading, and we can do that separately, but this is not it. So I don't care what the numbers will look like, because it's short-term noise. The only time I'd care is if all of a sudden Microsoft said, actually, all our accounts have been fraudulent, our company's rubbish, it's going to go bankrupt. Then I'd say, okay, the thesis doesn't apply, we need to get the hell out of it. Okay, assuming it's one of the quality companies. So look at all these distractions you've got stopping you from picking a core 20 stocks. It doesn't have to be stocks, by the way. It doesn't have to be stocks. If you're lower risk, and I'm going to show you some model portfolios in a moment. If you're lower risk, let me just show you something. It could be exchange traded funds. Okay, what are exchange traded funds? I'll just show you. So let's go down some. Here we go. I think that'll come up. Okay, you've got a bunch of exchange traded funds. There's thousands of them, but again, I want them green on all of these. Okay, and ideally, I want the correlation to be close to zero. Why? Because, well, Harry Markowitz got the Nobel Prize in Economics for showing that if you have a load of uncorrelated assets, you're more likely to get stupidly rich than if they're all correlated. You might call it diversification, but I'm going to show you a little image for which you got the Nobel Prize in Economics. None of these would meet my criteria because they've all got to be green over there. So you can see why being picky is important. I'll show you what Harry Markowitz worked out and why he got the Nobel Prize. He said, if you've got one asset which goes like this, okay, right, one security goes that, and then you've got another security which goes like this, if you mix them both together, you get a combined portfolio which is like this. Goes up and has no volatility or negligible volatility to the downside. So you took volatile security number one, volatile security number two, and you ended up making money with less volatility. Nobel Prize in Economics for that. That's what we mean by lack of correlation between securities. The biggest hedge funds in the world are actually paid money to ensure that their portfolios have as little cross correlation as possible, because that's where the money's going to come from, as long as the individual securities are skewed upwards. That's the ideal mix. I'll show you a model portfolio in a moment, what you're trying to do. And the reason you're trying to do that is because nobody likes volatility to the downside, unless you're a complete psychopath, in which case you might as well just pick one stock, but you'll have individual stock risk, which is why even Warren Buffett doesn't have one stock. Okay, and he has a mixture which their correlation across each other smooths out those returns, because we don't like downside risk. We don't like risk. What's risk? Risk is the probability of missing a certain return. Return, everybody understands. Oh, that's a return. What's your average return? Oh, 20% per annum, whatever it is. What's risk? Risk is, well, I might be 0%, or I might be 40, or I might be 0. That's risk, the probability of missing it. And we want that to be as little as possible, so we've got as much certainty as possible, so it's close to a bank account as possible, which will never be quite. Like I said, 18% volatility. Compare that to a bank account. 0% volatility in a bank account, 18% in the S&P. Do you see the difference? So I'll get more into some of the stocks that we're going to look at, okay, in just a second. But I wanted to give a bit of education to begin with, because I think this stuff is really, really important, okay. So more of this. Thanks, Rob. I will do some of these. Yeah, Raheem. Is there a reason for the difference in the approach? I'll answer all of these questions as we go on. So feel free to answer these. Thank you, Chetan. I'll answer that as well as we go on. So do put them on, and I'll explain it. So let's look at some of those UK ETFs versus the S&P. So what we did a little experiment last year, and we said, well, which ones were up last year by at least 18%, okay? Given that they're very low volatility, that's pretty impressive. That's like saying which Ford car beat the Ferrari, okay? Which ones were up since the last 5 years would have doubled our money? Which ETFs would have doubled our money in the last 5 years? No guarantee they'll do it in the future. And didn't fall as far as the S&P in 2022. Now, I just happened to pick the S&P. I could have picked a random number. I could have picked anything, okay? and which have also done well. The problem I've got, and these are some really good stuff, but the problem I've got with any of these at the moment is, I'll show you, that comes into it. There's a problem. I don't want to buy when the average prices are falling. So there'll come a time when I'll say to my family, possibly my son, I don't doubt my son, maybe my wife, I'll say, yeah, get in, but only when the average prices are rising, i.e. this is going up. I don't want to do it when it's falling because this happens and I can get cheaper. So I can pick it up at 30,000 in the expectation it's going to go back to 36,000. I'll make a quick 20%, well, quick. I'll make a good return. Why don't I want to do it when average prices, i.e. this is falling? Because it generally generates a 0% return at best, and at worst, a negative return over a prolonged period of time. What's great about such low volatility, remember it was low volatility exchange trade funds. If we go to the ultra low risk people for the moment, before we go to the high risk gamblers, okay, the ultra low risk people, what they love about exchange traded funds is that the drawdowns, i.e. drops, write this down, drawdown danger equals depth times duration, D, okay? The drawdown, peak to trough, and the duration till you make your money back, if that is small, drawdown is small, the depth is small, and the duration is small, then there's less risk. So if that triangle is really tiny, there's less risk than if it's like this, big drop and takes freaking years to make your money back, obviously, right? Well, ETFs tend to have that. That's what we mean by low volatility. And that's what we want. Okay, that's what we want. So this one is one that eventually I could say to a family member, okay, now's the time when it looks a bit more like this. Now, when's it going to do that? I don't know. How long will it take? I do not know. Don't have that crystal ball. I don't know. Well, but you should be able to get you got your degree in economics and politics. You should be able. It is useless for this stuff. It is useless. How useful do you think is British economic history since 1870 on working this stuff out? Oh no, we must be able to. You've got too much reliance on economists, my friend. Okay. Now, US quality dividend growth. Great little ETF, low risk, 4%, nice, drops, drawdowns are shallow, recoveries are quick, good little return. Not at the moment. I don't want it at the moment. Look at that. That's falling, what I'd call a daddy bear. So I don't want to be in that. And they say, oh, you're coward. You should get in right now. Get in. Well, you can if you wish. And if you want to get in, what I'd suggest you do is, there you go. You can do this all in immediately without waiting. Your danger is you'll have full exposure to any further declines, and you'll have high emotional and financial stress. And if you're a bit more cautious, well, you can always do this. You can cost average if you so wish, small regular events if you so wish. You can miss some of the early gains, but the danger is also the indicators aren't right. I mean, they're not 100% correct. If they were 100% correct, guess what? We'd all be sitting on a beach in the Bahamas. But they're a pretty good guide. You can check how good a guide. Just go on to Google Finance and put these tickers in. The ticker symbol's there. You can just put it in yourself. Okay. Now, you've also got this, very good, low volatility. So again, you some good, nice volatility. You know, if you want, get this, go to bed, never wake up. And, you know, you'll, in 2020, you would have been at 600 and you peaked at about 1,200. So you doubled your money in those, what was it, 4 years? Not bad at all. Okay, doubled your money. Not bad, 600 to 1,200, but you've come off a bit since then, but you don't care because you're going to just buy and hold it forever. However, what I like to do is a tiny bit more, and you don't have to. If you don't like it, don't like my reasoning, is because historically that pattern tends to be associated with falling prices and prolonged 0% return. So I tend not to want to be in when we've got that kind of a pattern, okay, as we have now. Now, sometimes it's short and shallow, like here, and you might not be in for a short time. Sometimes it's a bit longer. I don't know how long it's going to last, okay? Just me and how I feel about it. Similarly, it's a really good one. There's this ticker symbol, MVUS. Go to Google Finance, shove it in, you can see it, but not for me at the moment. There might come a time. Now, is this going to give me enough return? Not for my portfolio. I've got higher ambitions, but for my wife, yeah, I should be all right with this, but not right now, but in the future at some point. I've got an aunt who's 70. Will this be suitable for her? Yeah, but I'm going to tell her when. I'm going to say, look, I'll let her know when it gets closer to that pattern. Will that take a year? Might do. Will it take 3 months? Might do. I do not know that bit, which is the bit where I have to watch. Why don't you just do it now and just dollar cost average? Well, I could. Okay, you saw the pros and cons earlier. Very simple. Go away. Done. Job done. You can take the rest of the evening off. Let's talk about individual stocks for a second and why we're looking at filtering across our database of 10,000 stocks and 6,000 exchange traded funds by these filters. That from Goldman Sachs Wealth Management, this from Nobel Prize winners, Sortino, high average return, low downside risk. And this is where we cheat. That's what all hedge fund managers want. I'm in Geneva on the 15th, speaking to a whole bunch of high net worth family offices, and I'll doubtless be talking about the Sortino ratio because that's what rich Swiss people want to know about. What's your Sortino? In other words, are you consistent in average returns with low downside risk? Now, you might say, absolute bullshit, Alpesh. Undervalued companies obviously aren't the ones which will go up. No, you want to try and find the ones which Donald Trump's going to tweet about or will be the next meme on Reddit. Thank you very much. You can leave now. Go see the psychiatrist. Okay? Or growing companies, bullshit. You don't want growing companies. You want absolute dregs of the earth about to go bankrupt, and then you roll the dice on those puppies and hopefully somebody will do a takeover and they'll bounce up. Thank you very much. You can go back to living under the bridge. Okay, so Croaky, Goldman Sachs Wealth Management, the approach we take, like they take, is more scientific. Look at the historic data, see if there's any kind of correlation, which doesn't necessarily mean causation, might just be accidental correlation to subsequent price moves, and does it make sense? So a cash cow company which is high growth, undervalued, keeps producing good returns overall over a prolonged period of time. Does it make sense? Yeah, of course it bloody makes sense if we know when we live in the real world. Yeah. Okay, by the way, while I'm on the subject, all companies have three sets of accounts. They have the P&L, the profit and loss basically, the balance sheet where all their assets are, and the cash flow statement where you're basically writing down the cash that comes into the business and goes out of the business. Stock market crashes come from one of three sources: P&L, balance sheet, or cash flow. Okay, for instance, to give an example, the credit crunch 2008 came from the balance sheet not being worth what people thought. Okay, all of a sudden those properties that were on your book at Bank of Scotland were not worth what they previously were told they were worth. So balance sheet crisis, crash. Okay, COVID was a cash flow problem. In other words, shut all those shops, close all businesses, no public can go out, no cash is coming in. So guess what? Crash. Okay, dot-com bubble, that was a P&L crash. Why? Oh shit, look, those companies haven't got any profits, right? So what's going on at the moment with what's going on? Well, it seems to be a bit of, with tariffs, it's not a crash. What's going on with that sort of drop in the markets? Well, it seems to be a bit of P&L, not really a balance sheet issue. Okay, cash flow issue, yeah, sort of people might be trading a bit less because taxes have gone up, there's less profits. So it seems to be a combination of these two, but it doesn't seem to have been too sharp a fall. All right, now, where are we at the moment? So far, the US market, minus 5.2. Why do I focus on the US? I wrote about this in my first column in the FT 25 years ago. And the reason is, excuse me, no, he's not going to do it. He thought he was going to sneeze and he didn't. A bit like the market. Thought it was going to crash and it didn't. The reason is there's more choice of companies. There's just more choice to choose from, so I can filter better. I get more CVs. The fact that they happen to do better, I think, is just a function of the amount of choice. You've got that many companies that are going to do better. Maybe it's a circular argument I'm making, but more choice. Whereas in the UK, people say, well, what about the UK? Well, historically, UK hasn't performed as well as the US. And not only that, we've only got 100 large companies. That's it. After that, you've got 250, which are smaller. So that's 350 companies, which is the FTSE 350, 100 plus 250. After that, you're into the bloody small caps. You haven't even got liquidity. When we first set up the hedge fund in 2004, we thought about having non-US stocks, having UK ones, and we found there were about 10 companies we'd have enough liquidity in. And that's when we were small to trade on a daily basis in and out. There was just not enough trading going on in them. It's too puny. Now, those are the ones which are really dragging the S&P down because the S&P is weighted by the size of these balloons, these bubbles. It's what's called capital or market cap weighted. Okay, but in actual fact, there's been a whole host of companies which have been doing well this year, and there's a whole host who haven't. We'll look at some of those now. The fact that there's a whole host doing well and some not doing so well, that's a trader's paradise. But for investors, we still want to focus on quality and time. How's the past week been? So let's get back into some of the past week aspects. By the way, just resetting this poll, 36% of you believe that the FTSE will be high by the end of the year. 36% think it won't. What about the Dow? Let's have a look at this. And I will answer all your questions, Raheem, Keith, Rod, Glyn, Jonathan. Don't worry. Oh, no, not Jonathan, Glyn. Okay. Past week, this is how it's been. Wow, Microsoft up 7.4% in just 1 week. Apple 5.7, Amazon 8.2, Tesla 22% up in a week. Traders love it. And it's there, that kind of noise is there to suck you in, and you think, oh, I'm missing something. Somebody's making money somewhere. I can feel it, and it's not me. Well, that's great if you like to gamble. All right. Now, NVIDIA. Okay, 10% up in a week. Alphabet, Meta. So what? Warren Buffett would call this noise. So would I. Okay, fine. I can't read anything into this. Private investors have a habit of seeing patterns and coming up with explanations where experts would be a lot more reticent and humble because we've had our teeth kicked in often enough. I used to do a thing when I used to do talks for stockbrokers like Charles Schwab or E-Trade or IG Index, City Index, whatever. And I used to show them a bunch of charts and graphs. And I'd say, what do you think this graph represents? And they say, oh, well, that must be stocks, or that goes up when the yellow line goes up when the green one goes, there must be a correlation. And then I'd reveal that they were just random numbers. Okay. In actual fact, I stole it from somewhere else. And if this isn't too crude, the place I'd stole the idea from, there's a website which now has brought all that up to date and does it now. Back in the day, it actually showed the names and frequency with which various women on page 3 of The Sun appeared, because that's the world we lived in back then. And it was to show that has absolutely zero correlation to the stock market. There's nothing which has less correlation to the stock market. And yet people go, nah. When Cindy's on page 3, look, the stock market goes up. They would look for patterns where they don't exist. Or as Nassim Taleb would say, they're fooled by randomness. So that's noise. I mean, I'm not reading anything into it. You'll have a desire to do it. It's human nature. But we want to look at deeper than that. We need to look at what are the companies from the balance sheet, P&L, and cash flow statements. What do they actually look like when we look at the data? Why? Well, because it's our children's future that we're looking at. That's why we want to have a look at that, and that's why I put it into that little data sheet. So it just saves me a lot of time, and I get something more serious. Past year, Apple's up 24%, Tesla's up 71% over the past 12 months. Walmart's up 60%, Costco's up 37%. Right, Broadcom's up nearly 50%, Nvidia's up 31% over the past year. Surprisingly, Microsoft's down over the past year, and it surprised me, which is why it's one of my longer term holds, although at the moment I'm in cash, and I'll explain to you why in a moment. But it's one I know I'm going to buy back because I'm just sold it temporarily so I can buy it cheaper later. Why didn't I just keep hold of it and just put more cash into it later? Well, because I could, but because I'd rather just buy it cheaper later. If I was Warren Buffett with trillions sitting in the sidelines of cash, I might have done that. Palantir's up 434% in the past year. CrowdStrike is up, Fortinet is up, Berkshire's up 32%, JP Morgan 26%. So, well, and by the way, if in the next 12 months we get a chart pattern map like this, I think you and I'd be pretty happy. Netflix has doubled in the past year. Okay, so there's a hell of a lot to choose from. So let's look at what might look attractive at the moment, what I might want to own, what my son has, what I have, and so on. My son is 7. I'm not. I'm 53. Bureaucratically, I can't be bothered changing his portfolio and reviewing it every year. So, for instance, he's got Goldman Sachs and JP Morgan. And I asked him yesterday, we were doing some YouTube videos. He's 7. And we recorded them. And he has this lovely phrase. He goes, like and follow for more. Don't forget to hit that channel to see more of videos like this. Anyway, he's 7, but he's learned that off Minecraft videos. So I said, Rian, I explained to him, you have some JP Morgan and Goldman Sachs. I didn't sell yours. I sold mine, but I didn't sell yours. And the price is cheaper now. Should I buy a bit more because it's less money and I can buy more? Because in the long term, I think it'll go up and you'll make money. And he'll go, okay, Daddy, does that mean I'll still have enough money for sweets? Yes. Will it mean in the future I can buy more sweets? Yes. Fine. Do it, Daddy. So we bought a bit more JP Morgan and Goldman Sachs. Now, the reason is, those are the kind of quality companies I don't mind adding to over a period of time. And for him, I wanted to do it to make the point to my audience and my public. What I do, and what somebody else does can be different. You're not trying to copy trade or copy invest me, because I've got 2 private jets in the back garden just revving up as we speak. Okay, my point being, people have got different ages, assets, plans, whatever. And you can have 2 people making reasonable decisions, both will make money, he will, I will, but because they're doing it through a different route to get to the same destination, they'll still both get to the same destination. Okay, so the way he's doing it, or I'm doing it for him, is I don't mind this part for him, whereas for me, I'm doing more this part. Okay, because for me, this is a bit more time consuming, and I don't want to do it for him and his mum, because it'll be triple my workload. Whereas this, for him, very simple. So we added a bit more. Now, could I have held on to his Microsoft, Meta, Apple, Amazon, Alphabet as well and not got out of it? And I'll show you those in a second. Yeah, I could have done, but I wanted to make the point. With some we did, with some we didn't. So let's go back into some of these and let me show you where we are with these. Okay, now exchange traded funds, I'll do a video at some stage. I've not done it yet. You yourself can go onto Google Finance and put INDA in, and I suggest you put this in, and you can use the Daddy Bear rule that I'm going to show you in a second on entry and exit with exchange traded funds. Anyway, and those are 2 worth looking at. I've not looked at them recently, but it's pretty straightforward. I think I showed you guys it last time, how to do that yourself. Okay. And let me just have a look at that. I think, yeah. Ugh. Okay, so this is Google Finance, and you can shove it in, and there'll be a chart thing somewhere here, won't there? And it's all free anyway, and you've got a load of news. 5 year. There's a I can't find the chart button. It'll be there somewhere. You can look it up yourselves. Anyway, what I'm saying is I'll do a separate video on the rest of these, and I can do some Q&A later. This is where we are on the markets at the moment over the past year. Okay, that's where we are over the past year on the market. And it is what it is. Did I think 2023 and 2024 were going to be spectacular years? Well, I didn't think they were going to be as spectacular as they were. Did I think they were going to be up years? Yeah, well, that's statistically more likely than not. Did I think 2022 was going to be a down year? No. Did I think this was going to be a down year? It might not be, but by this stage, no. Thought it would be all right, actually. Okay, so where are we? Just some of the top gainers so far, last 7 days and last year. Okay, these. Now, I know at some point, and I'm not in these at the moment, I will double my money on this, I'll double my money on this, and on this, Tesla's too volatile for me. I'd rather just have Bitcoin. If you love it, good for you. I just don't like the volatility of it, okay? I don't like it. Others do. You know, there's certain rides at the fairground I don't like going on. Others do. Good for you. Wonderful. I don't want to contradict you. Now, I'm not in these at the moment because they are all in what I call a daddy bear phase, so I don't want to be in them, but I think they're quality companies for the long term, and I know I'll double my money. Now, if it takes 5 years to double my money, then it takes 5 years. If it takes 3 years, now, it'll take 5 years if there's a down year or 2 in that period, and if there isn't, it might take 3 years. Whatever it takes, it'll take. I can't force the market. What's the big thing for me? Well, for each one of those, yes, we looked at these factors. Of course we did, right? And right, the reason I'm not in those is because they're in that situation. When will I get back in? Well, I'll let my clients know. When I get back in, they'll be the first to know. They'll be the first to know. All right, why am I not in the S&P 500 and sold my triple leverage in March and my double leverage in March and my underlying index as well? Well, because of what I call the daddy bear, where the short and medium-term prices are falling, because it's like this situation, and that situation was like this. You look at this, you go, oh shit, it looks like that. Ooh. Now, to be fair, I got out late there and I got out late here. I get out late. If you want somebody who gets out at the top, good luck meeting that shaman, that crystal ball reader with the time machine. I think it's called Doctor Who. Well done, you found him. And to be fair, I said, or even when it was back here, oh, look, it looks like it's overbought, could fall any time, and it just kept going up. But we didn't have a reason to exit, so we didn't exit. Here we had an exit there. So for months I was saying, no, it's going to fall any time, going to fall any time, going to fall any time. So does that mean I was wrong? Yeah, because it didn't fall, but I didn't have to exit. Similarly with this, still holding cash because of that position, which is like that. Will I get back in again? Yeah, obviously I'll bloody get back in again at some point. Look at what this thing does. It goes from 160 to 470. Why didn't you just stay in? Well, because I don't like periods like this of making nothing. I'd rather step out of this period and then when this starts moving upwards, get in and make that gain. So where you make 0% over 2 years, I make 100% over 2 years. Okay? Because I stepped out, stepped back in. Happens rarely. Happened in 2022. Didn't even get a chance for it there. And it's happened again today. Okay, or at the moment. And what if you end up being so late, Alpesh, out and so late back in that you get in and out at the same price, or worse still, you get back in at a higher price? Well, that's fine. I still missed all that volatility, which I'm happy to do. If you're not, you stay in all that period if you wish. Why am I out of Amazon 2 times leverage, which is one of my favorites? Amazon Alphabet. Why am I out of all of the leverage ones? Well, you bloody well see why. 8,000 to 4,000, 50% in no time. Well, because if you see that on the underlying Amazon, that's what I don't want. Why don't I want it? Well, look at this. Look what happens. You go from 8,000 to 2,000. Gamblers love all this. I'm not a gambler. That's why I keep a close eye on it. And when we did it in 2003 and went from 2,000 to 8,000, I actually exited closer to 6. So tripled our money. Thank you very much. Over those 2 years. I'm happy with that. Why didn't I just have Amazon and nothing else? Because I don't have a time machine. I didn't know Amazon was going to do that well. Otherwise, I would have just bought that and nothing else and would have said to you, just do that and see you all on the beach. Why Alphabet? Similarly, when we got in the underlying, as you know from my YouTube channels, because this was rising, the momentum was there, and obviously all the fundamental factors hit. But at the moment, would I have it? No, would I? Hell, because of this. It's too volatile. And it's falling. Okay, so we'll wait when it goes in. I'll tell my clients when I'm back into that, but it's not at the moment. I don't even want to buy a bit. I mean, that might have bottomed. I don't know. It might have bottomed. Might be the bottom of the market for all I know. But I fear it'll be like this, and then boom. And I don't want to get in at 6,000 only to see everything drop to 3,000 and I've lost 50%. Well, you make it back again, Alpesh. Look, a year later. Yeah, but I'd rather have had all that money entered in at that point, closer to, say, 4, going to 6, and make 50% return, whereas others are making 0% because having to wait for it to recover. See? Very simple. I'll get into this at some point. I'm not in it at the moment because of that. When it's closer to this, I'll get back in. Why? Well, because I think there's a future in semiconductors. What do you think? If you can't see, I'm drawing lines to make you see, then leave now. You shouldn't go near sharp objects or the stock market. Why you think, well, if you can't see why there's a future in semiconductors, but not at the moment, I'd just rather wait. Oh, but I think that timing, call it what you want. If you don't want to do it, and if you do say that, then you should leave as well and just stick to bank accounts. Apple is there, but sorry, that is too similar to that. Now there I got wrong-footed. If you remember, I exited half of it, ended up buying that half back at a slightly higher price. Might happen again. Doesn't matter. I'd rather have just stayed out and slept easy and seen those drops. This is the return histogram for Apple. Now, it's not guaranteed to happen in the future. Look at that. Over 250 days, there's a pretty good probability of having a positive return, but you've got to go through those 20 days where you lose 22%, or in 5 days, there's a very small probability you lose 24%. This is called panic, okay? That's called panic. This is called, after 100 days, you're down here with no return. That's called boredom. Boredom and panic are two twins. They're two really fat, ugly twins who get in the way of this, which is called returns. Okay, so returns are over here, but to get to returns, you've got to get past boredom and panic. And boredom and panic are really scary people. I might write a book about this for my son. And that's what panic looks like. After 5 days, it drops. And boredom looks like this. After 100 days, 0% return. And if one doesn't get you, the other might. So I'm going to do a little game where we go like this. And it goes, do, do, do. And eventually, when you can get past both of them, you get to returns. Okay? Now, Occidental Petroleum, I don't own. I don't know if I'll ever buy in the future. I'm showing it because Warren Buffett has a lot of it. I'd want to see that rise up. I said before, oh, maybe this is the bottom, and it wasn't. So there you go. Why is Mr. Buffett still holding it and very calm about it? Well, because he doesn't panic and he doesn't get bored. as you will know. He neither panics nor does he get ever bored. So he's still holding on to it. So we'll see if he knows something I don't, which I'm sure he does. I don't like the statistics of this, that there's a strong probability. Well, I think that's high probability of having 47% loss after 250 days. He definitely knows something I don't, but I don't like these numbers. Okay, I'll answer your questions later. Do feel free. No, all the charts are the same as before, Vilvo. There's no change. NVIDIA Corporation is like this, and Daddy Bear. Now, here's the interesting thing. I may well. Do you think that's going to drop lower? I don't know. Might have bottomed. When I exited in March, I may well end up buying back at a higher price than I exited. That's fine, because I just slept easy for a month. Now, why did you exit, Alpesh? You could have stayed in. Yes, I could have stayed in. Like here, you could have stayed in and taken this drop, lost 70% of your money, and then made it all back and had a 0% return over 2 years. You could have done, or 18 months. You could have done that. I'd rather try and get in a bit late there, and get that return and keep my powder dry and have a good night's sleep over here. That's just me, though. You don't have to be like me. You can do it differently if you wish. Okay, horses for courses. It's like religion. We'll hopefully all get to the same destination, but through a different path. Okay, now, where are we with this? That's what NVIDIA looks like. Not bad, eh? Not guaranteed, but that's not bad, is it? Except you've got to go through a 20-day period of panic, and then Panic's twin brother, Panic 2, comes in, and Mr. Panic More, their daddy, comes in there. Okay, so it gets pretty bad. The one thing with NVIDIA is they ate boredom. There is no boredom. There's only panic. There's 3 twins, panic, triplets. Okay, Tesla won't give you boredom, but it'll give you a shitload of panic. I mean, I know it's at 2021 prices. You want to go and interpret the fundamentals on that, it's up to you. Tesla is an intellectual property company. It is going to sell rockets and time machines in the future, as well as robo-taxis. It's not a car company. So if you believe in that thesis, you're happy with it. I just don't like the volatility of it. So in the past, when we've had it and said, look, it's rising, you should be all right, and we've got lucky at times, the volatility, and I say lucky because the volatility is so bloody great and the CEO is so erratic. Not for me, but I've got 10,000 stocks to choose from, so what do I care? Okay. As well. And I mean, you can see here, even after 250 days, you could be down 40%, 48, 52% down after 50 days. I don't like that roller coaster ride. Do you like that roller coaster ride? Good luck to you. Not for me. Do you see how I'm trying to make it as bespoke as possible to the individual, and try and also say to you, there's a lot of shit out there. You don't have to go pick every single piece of it off the street. I'm not saying Tesla is that, but I'm saying if you can't take panic, okay, and these are big panic, big brothers panic. You can't take those 3 brothers. 5-day panic, 20-day panic, 50-day panic, and 100-day panic. 4 of them quadruplers. No boredom, just panics. If you can't take them, then what the hell are you doing playing in that park? That's nice. 7 on our criteria. Okay. Ooh, that's okay. Bit of boredom. Tiny bit of boredom. Well, maybe not much. Nice. Stocks most loved by hedge funds. Now, there will be a time, it's not now, where I'm sure in my portfolio, my sons and my wife's have Amazon, Meta, Microsoft, Nvidia, Alphabet, Apple. There will be a time. Taiwan Semi, there will be a time. MasterCard, Visa, probably. Berkshire Hathaway, Eli Lilly. Alibaba's a bit volatile. I don't like it as I get older. There will come a time. It's not right now. Not until that daddy bear situation is over. But that's just me. If you want to get in now, fine. If you elongate your time frame, you'll make more of a return. If you are a mad, insane trader who wants to know what's going to happen in the next 5 minutes, I've got a spread betting brokerage you can then open an account with, and I'll take the other side of the bet on that, and I will make shitloads of money, and you'll be dirt poor. Okay? Now, this is from Goldman Sachs Global Investment Research. This is the typical bear market and what it looks like. Last year of the bull market, 21%, which is pretty much the S&P last year. You get one last fandango, get a bit of a drop, get a bit of a rise. Are we here? Very volatile period, by the way. Are we here before we get the drop? Might be. I'm not sure. So today's Wednesday. Is it Wednesday? Wednesday. I'll wait till Friday. Friday, I'll wait till Wednesday. I'll decide. But at the moment, I don't need to be hurried into a decision. Not like Warren Buffett. I'm sitting on $1 trillion in my bank account. No, I'm not. But my point is, I'm willing to be patient with my cash. It's my bloody cash. I don't have to go and give it. I don't have to use it. Worst thing I hear retail clients saying, I've got money, it's burning a hole in my pocket. I love retail clients. They're just insane. In my next life, I'm going to do two things: open a casino and open a spread betting firm. Because on both, I can be the house and they're going to just blow their money. It's incredible how risk crazy they are. My job for my family is basically to turn 10 into 100 into a million. I wish I could do it overnight. With all my qualifications, all the books I've written, I can't. In the 1980s, there used to be a saying, okay, property prices will double in 3 years if there's no recession. If there's a recession in the middle, it'll take 5 years. In the 1980s, that's what used to happen. I think it's happened in the 70s as well. Okay, then it broke down because governments hate it if plebs get rich, so they try and stop that from happening. So they crack down on property and second ownership. They'll start doing it with pensions because they hate the fact that regular people are getting rich. Generally, that's what happens. They don't say it, but it's the outcome. So what we did in the past, and students, we used to give them little medals every time they got a stock which had 100% return. Great. Okay, like Crocs and what Ravi did back in the day. Look at this. That was 2021. What great times. And why we were holding for 12 months and reviewing, and with stocks it's more volatile and stocks are more risky, is they can then fall back. Okay, so there was a 12-month holding period, which I'm still happy to hold, but I try and remind people now, listen, individual stocks tend to be more volatile than funds, and some stocks are more volatile than others. So if you're at the Ravi end or you're in your 20s, you don't mind volatility of, say, 18%, 20%, and a shorter holding period of 12% and want to look at it, that's fine, because you want to try and get more return quicker. But if you are older, or if you're like my son, not capable of managing your own portfolio because you're busy eating sweets, then you want to elongate your time frame and have lower volatility. I mean, you can still have high volatility, but you want to make sure it's quality. But lower volatility will give you more sleep in the evenings. So let's look at that. By the way, yes, this is the stupidest way. My profession is the stupidest way to make money. Okay, I happen to be co-chair with Lord Billamore, who's the founder of Cobra Beer, was one of the investors in my hedge fund originally, of Lord Lumba's foundation, and I have been for about 15 odd years. The reason I mention this is occasionally my students take note of this, and one or two have been very generous. They've supported widows and orphans. So if you feel any of my education does make you stupidly rich, do feel free. Also, follow me on LinkedIn. Now, I want to go to a few more things. There's some ton of free resources over there. But one of the things I want to go to is the questions, and I want to show some charts. Hi, Alpesh. Do you have a view on why drops in the S&P were so rapid this time? Trump-given panic or something else? Because there was so much profits. And at Bloomberg, what they often used to do is try and come up with an idea as to why a stock might be up or down. And in the end, I'd just say to them, because I was actually investing, I'd say, no, we wanted to take profits. And it's like a Mexican standoff. Shit, who's going to take the profits first? I want things to keep going up, but if he takes profits, I'm going to fall, so I better do it before him. And then somebody else goes, well, I better do it before him. And then it's like dominoes. So I think it was just that. It was just the profits had been bigger. If the profits had, and the overvaluation would be so great, nobody truly believed how much money they were making in 2024 and 2023. I didn't. I mean, the NASDAQ was up 55% in 2023. Did I believe that windfall? If you get a windfall, what happens to you emotionally? Just ask yourself. You get a bit more, bloody hell, I don't want to let this go. What a windfall, okay? And so you sharper sooner, I think, unless it's something I don't know. This is what I'm really looking for stocks, especially if I'm going to leverage them 2 times. This happens to be, I think, Apple. Previously, so I've got to be able to withstand in 20 days, if I've got 2 times leverage, a 40% loss of the value of my portfolio or that holding. And yet I know over the longer term, if I can get through that, I make money. The biggest advantage I have, and Warren Buffett has, and what makes us money is we know this, and we know we've got to get past panic to get to return. But that only happens if your stock looks like this. And there's very few that do. Out of 10,000, there's about 10 that look like this. Okay? And most people can't get past that. They can't get past this. And by this stage, guess what? Boredom kicks in. So if they do manage to get through panic, they have a fight, they get through panic. Oh, they beat panic 1. Panic 2 came in, and then all of a sudden, 100 days ago, oh no, boredom gets them. It really is like a game, okay? Me, Buffett, and a few others, we can get through that. There's the news headlines are there. They come in and they go, I'm going to panic you. Warren Buffett put it really well. He said, breathless headlines. They'll come in as well. Peter, at the moment, instead of RORO, risk on, risk off, we are now in Toto, Trump on, Trump off. I love it, Toto. We're not in Kansas anymore. Fundamentals are also risky. Sit it out for now. I'm happy to sit it out. Peter, if you're happy to sit it out, you have done the right thing for you. Others have FOMO, so they might, and I'd suggest to them, they don't go in with both feet. They might just want to go in with a little bit and see if they get any buyer's remorse as soon as they've bought in. Hi, Alpesh, how do you view on why the drops? Oh, sorry. What's your quality 5 drop down stop loss? There isn't. The nature of a quality 5 is actually, if it's a daddy bear, I'd exit. But if it's not, I'd probably even want to add to it unless it gets too concentrated. That's the whole nature of the quality 5. The rules for them are just amazing. Do you have an opinion on Fiserv? I don't at the moment. I've not looked at it, I'm afraid. I think you mean, Chetan, hi, Alpesh. I've tried to figure out how to get the same MSC on Yahoo or any other website. Which time periods do you use? How to track it myself? Yeah, Chetan, the monthly chart and the monthly MACD, and if you put the monthly MACD and the stochastic will look like the weekly. You won't be able to do exactly what I do because I use Trend Spider, and that's expensive, so you don't have to use that if you don't want. I think we're still here. Okay, I still think we're here. That's why I'm out. Others don't want to be out. My neighbor asked, he goes, oh, you must be really worried at the moment, with the markets and everything. I said, no, why? I said, I'm in cash. She goes, oh, okay. She goes, we were on a cruise. They were on a cruise in Portugal. She goes, one of the other guys was just constantly looking at his pension. I said, well, he's bloody insane. He's going to blow it. I want to talk a bit, as I answer your questions, about how fund managers destroy your money. The biggest problem with fund managers, and I'm going to show you this, okay, is that they can't hold cash and they'll spray and pray into a bunch of stocks, okay? And that's the biggest problem with fund managers. They can't hold cash in the falling market. So Scottish Mortgage Investment Trust lost 50% of your money in 2022. The best example I'm going to give you is Meta. If you look at Meta here in 2022, famous company, right, dropped 76%, right? We got out because of the daddy bear situation here, right? We got back in when this started rising in the January of that year. Now, over 2 years, the fund manager gets 0% and says to you, and the wealth manager says, oh, aren't I clever? Look, you see, I told you to hold on. You made your money back after giving you a bloody heart attack in the first year and 0% return. Whereas we managed to get from January to there 187% return over 2 years. 1 year 0, the next year 187 on that. Actually, with the 2 times average, a bit more. Now, if I was really clever, I would have known it was going to drop 76%. I didn't. I would have known it was going to go up 187. I didn't. I just knew it should be one of the stocks I hold because the momentum was rising and it hit all our other green criteria. That was it. Had I known it was going to be this much, I would have, as I've often said many a time, and you'll remember this, I would have sold my mother-in-law on eBay, taken the money and put it into this. Okay. But I didn't. So that's why you're screwed with fund managers, amongst other things. I mean, that's one thing. And the ones who, guess when they advertise the most? They advertise when statistically by accident, one of them's an outlier. That's the time they start marketing for more money. Fund managers will divide your capital because they're a marketing agency. They'll divide your money because they get paid on assets under management, so they have to market to get more assets into geography, style, and theme. In other words, UK, value growth income, okay, AI, right? So they're divided. That means that they've got their hands tied behind the backs because they only can pick from a very small group of companies which fit that geography style. So you're screwed if you can only pick from a small group. Well, it's like saying, let's pick the best World Cup team, but they've got to be people who come from Watford. That's literally what they're doing. Okay. Plus, they're paid either way anyway. Watch out for these little tricks that fund managers use in there. They love letters. They'll put diamonds there. It's bullshit. This is all bullshit. Okay. They'll use terms like booster. All bullshit. In fact, they'll just do negative returns over prolonged periods of time. So just be careful with those. Okay. I'm going to show you a model portfolio. So what we did is we did the absolute worst horrific thing we could do. We took from February of this year, remember the market in the middle of February peaked at an all-time high. So we went back and we said, what would have happened if we picked the worst possible time, the start of February, to pick our filtered stocks, okay, filtered stocks, and the highest volatility ones, not the least volatile ones, the most volatile ones, okay? What would have happened if we did that, okay? Given that they were still hitting all our filters, how did they do in the preceding 5 years when they didn't hit our filters? Did they do okay previous to that? And how are they going to do going forward? And if they replicate the previous 5 years, that'll be good. So we went back and we said, well, how did they do over that period? And we took a period which included the stock market drop of 2022, where the whole year the market dropped, and March and April falls as well. And we were looking at a 30.9% historic return. Doesn't mean it's guaranteed to happen again. If you said to me, what do you think can happen in the next 5 years with that portfolio? I would say probably similar. Risk was 25%, which is a bit higher than I'd want. Drawdown was 34%. Okay. And you can see the variety of returns. You had ones which over the preceding 5 years, some had just never generated a positive return, were just down 10% per annum, down 20% per annum. Others made up for it. They were up 40 or 52, even though they met all our existing filters right now. They might not have done historically. They did now. So would we still buy them? Yeah, I'd still buy them. And look at some of the drawdowns you can have for 30% per annum. This is what 30% looks like. It means some stocks drop 73%. Okay. Their worst years in some of the stocks, you get a minus 45% return, minus 70% return. But that is what 30% per annum looks like. Can you see the volatility? That's what 25% means. When you show that to people, they go, I can't take that shit, Alpesh. Can I have minus 18, please? And then what we try and do is match that. I'm going to try and show you something if I can. Can I do it? Yeah, I think I'll be able to. What we try and do is then match that for them. I'm going to show you something really clever that we've got. I show clients, here it is. This, I don't know if you can see that on screen. Okay, what we try and do is, in an ideal world, let me try and blow that up actually, I'm not sure. Yeah, that will work. In an ideal world, the model portfolio with the individual stocks with all that data. So sometimes we just give them, well, with all of them, they get given the data. That's like giving them a recipe and they can make their own portfolio. And then with others, they want more hand holding and they want us to bake the cake for them and give them the portfolio. Now, annualized return is, look, it's going to be 10%, 15, 20, 25, 30 if you're lucky. You've seen some of those, but the volatility will be high. Now, I would love to engineer a 30% per annum portfolio with only a 10% volatility. That would be the SpaceX equivalent of those rockets that can re-land themselves. Even Elon Musk can't create this, okay? And the probability of being down after 1 year would be 0. The probability of being down after 2 years would be 0. That's a function, by the way, of return and volatility. That would be the best. And you double your money in 2.3 years. You are a genius, Alpesh. I wish I could create that. That doesn't exist. That's the holy grail. I'm still working on it. Not going to get it. I'm not going to get it. It won't exist. You know why it won't exist? Because those bloody companies don't exist. They might do sometime in the future. If they do, I'll let you know. But they don't. So how close do we get to that? We can get a 30 with a 25%. We've had one student who created one based on our data, and he put it together where over the last 10 years. Historically, it's done 30 with, it was close to a 15 return, which wasn't bad. But on the whole, let's say you get a 25 and a 15, okay, which is pretty good. You're still doubling your money in 2.7 years. If it repeats itself, history never repeats itself. And the probability of being down still exists after a year. You might still be down after a year. People don't get this. But 25% per annum, how come there's a 1 in 20 chance I'll be down after a year? I could be down after 2 years, Alpesh. And a 25% return historically, and you could still be within the historic performance of that. Do you see? Okay, that would still be in the bounds of reasonable. So a lot of people say, well, actually, let me reduce the volatility. I'll take longer to double the money. Maybe I'll take 5 years, but I'd rather just have 15% return than a 10% volatility, please. Okay, 10% volatility. Of course, you want 30% return, 10%. Well, I can't create it for you. This is more reasonable for low risk. This is more reasonable for higher risk. Okay, and this person, again, has some chances they might be down, but not much. That's how it's going to look, okay? Let let me move that out of the way and then go back to this. Let's say you invest over 15 years. 15 years, Alpesh, I thought you were going to make me get rich quick tomorrow. And let's say you can do 20 over the longer term, because historically the quality companies you selected have done that. There's no guarantee they will in the future, but let's say it's a pretty good guess that they will, and you do that and you put this in, then in 15 years you turn, okay, that into this. That's what it looks like, and that's the game. Why don't people do it? Well, for a start, it never looks like this. It goes like this, then like this, then like this, then like this, then like this, and they crap themselves. Okay, or for the first 7 years, they get boredom, because it's like, oh, well, compared to my contribution, I've barely gone up. So why don't people do it? Boredom and panic. That's why people don't get rich. Boredom and panic. It's not that they think they don't get rich because they don't have the inside information or they're not clever enough. Nope. It's boredom and panic. Don't ask me, ask Warren Buffett why they don't get rich. He'll tell you as well, boredom and panic. He says it all the time. Okay. Now, let me see and go for, I've actually shown it here. So, what an idiot I am. Let me answer some more questions. The market has only just started. It could be extended. It could take many years to recover if history repeats itself. Which ones took many years to recover? I think you're thinking the 1970s. When else did it take many years to recover? I guess 2001, took till 2003. Have you got the data on many years? I have got some data on how long they take to recover and how long they're underwater, and it's not many years. If by many years you mean 3 or more. So data-wise, Roger, it actually doesn't happen. Okay. Now, Keith, Rod, have you broadcast section on ETFs you were going to do? Let me know if there's anything missing. Raheem, Alpesh, you mentioned in your webinar email that you'd explain which stocks in your son's ISA. Yeah, Goldman Sachs and JP Morgan he's still got, and we've added to them. And of the quality 5, the 2 M's and 3 is Meta, Microsoft, Apple, Amazon, Alphabet. He hasn't got any of those at the moment, but there'll come a time when we do, but not at the moment. Okay, difference in approach. I just wanted to show a different approach. 2 people can get to the same destination of bigger returns later. This is it. The 2 biggest mistakes: boredom and panic. All right. And the best example I give of boredom and panic is this. That's Microsoft. Okay. That's Microsoft in 2021. Look what happened. 53% return. For 9 out of those 12 months, there was a 0% return. You can look at it. That's 0%. That was 0. That was 0. That was 0. There was 0% return for prolonged periods. 9 out of 12 months, you had 0 or negative return, but you made a 50%. So out of boredom or panic, people wouldn't get it. You can give them a golden goose and they won't do it. That's why I handhold people on the program. I've showed you that already. That's why I handhold them and give them flow charts, because you really need to do that. You need to do that. Okay. When we did it with medium volatility on the S&P, we could get, as I said, 26% and annualized return, 26% per annum, and 66% positive months. The most we've got is 70% positive months, but I don't really target that. What I'm really targeting is the lowest possible volatility, or put another way, a Sharpe ratio closer to 1.7. I haven't managed to get above 2 on that anytime soon, i.e. 2 times the reward to the risk. 2 would be 30% returns, 10% volatility would be, 3. Why is this happening? Why are people like this messing up your money? Okay, and the reason is, first of all, they spray and pray into a few funds. They divide it into, they can't hold cash, and they divide it into UK, Vietnam, whatever. And people think, oh, well, I've got a bit of Vietnam, a bit of China, I must be diversified. I must be making some money out of each of those. No, they're picking from very few companies in each of those. So you're screwed. Whereas you should be picking from 10,000 and the best, which is what Warren Buffett does. He can pick anyone in the world he wants. As soon as you start tying people's hands behind their backs, you're screwed. This is valuation. That's got to be a key factor. For me, it's really that one. That's secondary. Warren Buffett likes price to book. I don't care which of those you use, but be careful with discount cash flow. Growth, I want earnings and sales growth year on year in the companies. Income, that has a 10% weighting. That has a 40% weighting. The most important thing, and I'd probably say that is roughly a 20% weighting. and momentum is significant. We put that outside as a separate factor because it's such an important factor, and that comes from the hedge fund industry. But if you only look at this, you're screwed. You're going to so mess it up because this is the mistake. People, oh, I got momentum. Only look at the chart. You're just going to lose a shitload of money, and that's more important in terms of weights. But it's really an interpretation of the combination of both of these. That's important, combined with the croquis, which is also ridiculously important, as is the Sortino as well. On top of that, you've got to understand volatility. That's key. And cross-correlation in a portfolio, because no point having everything with the same correlation. You'd be shocked at how in different industries things are correlated to each other. And things in the same industry are often not. That's why we look at that. This is really good. Okay, things like this, they're really good because they show you years and years of data of what's worked in investing. Okay, that goes back about 100 years. It was in one of my books, and I published the findings and why and how we came up to the conclusions that we did. The Winning Ways of Uncle Sam. Yep, September the 11th, 1999. I'm selling all my UK holdings and only buying US ones. The choice. It's the choice. It was the choice. I've said it before. I'll say it again. Now, you said the reason you hate your IFAs and fund managers is underperformance. Yeah, they underperform because they're trying to keep your money for longer. And the best way to keep your money for longer is to have low volatility and try and send you to sleep. And you can still get low volatility. And they won't put you in the US. They'll put you in the UK because they earn bigger fat commissions from selling you expensive UK investment trusts because the fees are fatter because there's less competition in the UK than there is in the US. And therefore, the US has beaten down fees, and exchange traded funds, they'll never sell you because they get no fees from selling you ETFs, and they'll never tell you to hold cash. Okay, I've actually had fund managers come to me and confess, not just fund managers, wealth managers and distributors come to me and confess that they've been selling shit, and it's on their conscience. Okay, ingredients: make your own cake. That's that, or solution 2 will make the cake for you with something like shit. There's 2 ways of doing it. This is what happened in 2024. Now, that's not guaranteed to happen ever again. Let's assume I will never get another 40% return year. 2024 was surprisingly good. If years started not in January, but in April, okay, and lasted 12 months, then that wouldn't be anywhere near as good because it would have been April 2024 to April 2025, which would have included February, March, and March's downdraft. So it wouldn't have been as good. Okay. So a lot of that is down to, well, they start years in January and end them in December. Luck. Okay. And there was an updraft in the markets. But that'll make up for the years in which we're unlucky. We don't have to be smarter than the rest. Warren Buffett famously said, if you've got an IQ above, I think he said 110, the rest of it's wasted in the stock market. You really don't have to be clever for this stuff. Okay, you just have to be more disciplined. Pick your time frame. And the best way to be disciplined is just have a process, as I've shown you some of the charts earlier. Data and process. Data and process is what it is. Pretty bloody dull. Okay, there's your data, and the process is what I mentioned. I'm going to go into that again. Market risk. The only way to remove market risk is not be in the market. So at the moment, I don't want market risk at the moment. I still want the volatility at the moment with the daddy bear. But when I do, I'll get back in. Now I might have to make exchange traded funds. If I don't, I'll have 20 to 40 stocks. That's it. Because after 40 stocks, it's a waste of time. Below 20, too much individual company specific risk. There's the links. Do go to those. And on there, you'll be able to follow me on LinkedIn. You can schedule a call with my team, get free investment calls, free copy of my Investing Unplugged book as well. And my other books are on there, and my daily Telegram channel where I'll post things on there. Can I ride in your jet? Carl, I've got a Lime bike. Okay, I live in London. The reason I say, well, I've got 2 private jets is just to say, look, my situation is different to everyone else. Don't try and copy me because then you're gambling. Because you're basically saying, I'll just follow some bloke I've never heard of. Glyn, loving the S&P graphic. Thank you. I see you're looking at the MACD. Do you also consider... No, RSI is way too volatile. I've mentioned this in books I've written before. And in fact, I'll give you a copy of one of the books. Anyway, so underperformance is the main problem you have. Lack of communications, you guys have said, as well with your IFA wealth manager. I agree. I do a daily stuff. I do this twice a week. If your IFA wealth manager is not doing twice a week stock market broadcasts, time to get lost. Just sack him. fees, lack of information, education. There you go. If they're not teaching you all of this, it's because they don't know it, right? And they don't give you transparency. The reason I like to show clients all of this and give them the data is because they should be able to take my place on the BBC and do what I do instead. Okay, they should just be able to do it instead of me. By the way, if you want to see some of those BBC broadcasts, they're on alpeshpatel.com/shares. See there? If you go there and you click on those, you will see a whole bunch of my BBC interviews, which are talking about the stock market, amongst other things, on there as well. I might have missed some questions. Please repost them if I've missed them from earlier on there. Let me go through a few other things. We also look at what hedge funds own that are multi-billion-dollar hedge funds, which are generating over 40% per annum for at least the last 3 years, and see if any of their stocks meet us. Like I said, the goal is, can you get how long to double your money? If it's 15% per annum, it takes 5 years. If it's 20% per annum, it takes 3.8. Most of you might say, well, for that extra 5%, the volatility increases so much, it's not worth trying to save the 1.2 years time save in doubling. I'd agree with you. I'd say, yeah, stick to that, be reasonable, have lower volatility. I'd rather have lower volatility and take 5 years than have more volatility and try and do that. But there'll be some years like 2024, 2023, where we got 40% because the market gives a tailwind. There'll be others like 2022 where we had nothing. And if every year was like 2022, we're probably going to double our money in 35 years because I had cash in 2022. Okay. If that happens forevermore, I'll never double my money again. What do I think actually is going to happen? Well, the average positive return is 32% over a 2-year period on the S&P 500. And I'll go with that. 88.5% of the time, it's a positive return anyway. And 32% over 2 years, I'll take that. Okay, fine. Obviously, I will. And my job is to make sure this doesn't happen. I don't get any big drops. Because if I can save my money and preserve my capital, as Warren Buffett does so often, then I can deploy it 88.5% of the time to make the money. I don't need to pick tops and bottoms. Okay. I just need to be more disciplined than everyone else. Hi, Alpesh. The weekly past week and past year graphics are great visuals. Are they taken from TradingView? No. So I have a graphics team who put stuff together for me. I can't remember where she got them from. I'll have to get back to you where. Is it worth investing in the S&P now? It's in a daddy bear, so I'm not doing it. But if you wanted to, one of the early images I showed you was how you could get in early. By the way, have a look at the reviews, what we do. Easy to open SIPs and ISAs, whether it's Barclays, AJ Bell, Interactive Investor. This is the problem. Be afraid of name recognition like Scottish Mortgage Investment Trust. They lost 50% of your money. Fundsmith are going to do something similar for the simple reason they can't go into cash during these periods. What I want to do is create an asset management company parallel to my hedge fund business, but for retail clients, where what they can do is get the data themselves, invest themselves, learn how to do it themselves, not pay any subscriptions, get the data for life, get the knowledge and know-how and access to me for life, but not pay any subscriptions, and eventually be taking the business away from St. James's Place and these IFAs and wealth managers and empower the private individual themselves. Sounds pompous, but democratize investing. Make sure that the private investor has the data and the know-how and access to the know-how so that they can create it themselves and have the transparency and the communication, regular contact. And I take 10 people on at a time, as you know, on the program. Eventually, when we get to, I don't know, 400, 500, I don't know, get some venture capital investment, eventually IPO the thing. Given that St. James's Place with 900,000 clients was a FTSE 100 company. I think it's dropped out. Might have got back in there, and they're rubbish. They spray and pay and shove it into a few funds where they get lots of payment and do piss poor performance. We can just show you the model portfolios and show you their performance, let alone anything else. And in fact, as Warren Buffett famously said, when they said, well, don't you want to be known to be a great investor? He goes, are you kidding me? I've just been making money from good companies. I didn't invent the companies. Same from me. Thank you, Martin. Thank you, Glyn. If you'd like to join, okay, there's no subscription. It's brilliant. That's where you go. Okay, that's where you go. I'm afraid the prices have gone up from, it used to be just 1,000. Now it's 24 installments at that, including VAT. I'm sorry. And it's going up again. Because as we provide more and more information, data and everything else, it's going up again. But that's the ambition. But I'll continue doing freebies for people as well. Okay. Anything else? If I've missed anything, guys, just let me know and I will answer those questions. I'm sorry I've gone on a bit over time, but do let me know if there's anything that I've missed at all. And if you're one of the clients, don't worry, you've had the stock market update on the private Telegram channel earlier today, the detailed one with various stocks. And for those who are clients, don't forget, I've put up 2 new model portfolios, which are phenomenal, earlier today and yesterday. Now, where are we? I've got some others. Mark Slocock. When deciding to sell, are you looking at the S&P 500 MACD only, or do you look at individual stocks you hold as well? For example, would you have held Costco and Netflix this year? No, I didn't hold either of those because I think Netflix, I've just got prejudice. They were already overbought and I was already fully invested. Costco in the future, I might. And Walmart. In fact, I know I will at some point. They're just too overbought and too expensive at the moment, so they don't meet my criteria. But the reason I went into cash is if the S&P 500 becomes a daddy bear, I go to cash in pretty much everything. Other than, like I said, my son and my wife's portfolio, because I just didn't want to be so bureaucratic and show people that there is another way. You don't have to do that. You can just hold those quality companies for longer if you so wish. But the downside of that is what I showed earlier on, okay, as well. Any questions that I've missed, just let me know. Just scrolling up, chat then. No, I think I answered that one. Glyn. Have you? Oh, right. No. Yeah, I think I've answered all of them. So do let me know that I have. Okay. And have a look at this. You're going to love that page as well. Yeah, Gareth, Pips was just trading and it's no longer open to the public. It's only going to be open to people who are already on the Great Investments Program. So Gareth, it's a different group to the Pips group. Pips is just the trading one. Email me if there's any confusion. Just email me. Edward, no worries at all. And let me see if there's anything else. No, I think that's everything from everyone. So those who are joining and signed up, thank you very much. I will speak to you later. Welcome on board. Not sure any message came through. Can you review QQQ? I thought I did look at the NASDAQ earlier. And I said it was very similar. It was in a daddy bear to the S&P. I can tell you now because I know that from memory. God, look at how much we've covered in just 1 hour. Okay, where's it gone? There it is. The NASDAQ 100, so the cube, QQQ, yeah, it's in a daddy bear. It's like that. So I'm going to wait. I'm sitting it out. You'll be tempted to trade. If you wish, you can trade. I don't think it's available on 212 to purchase. Might not be. I don't know what's available on different brokers on there as well. No, don't worry if you missed it. No problem at all. Yeah, sometimes the connection can drop because I think there's bandwidth issues and all sorts of things. Yeah, just technology is not phenomenal, is it? Ever. Or I've got too many things on the computer can also make a difference, would you believe? I mean, honestly, in a serious note, that can make a difference. The other thing I want you to do, there's a couple of websites I want you to go to. If you go to, like I said, my LinkedIn over here, okay, you will see on my LinkedIn, you'll see I'll occasionally point some really good posts, really detailed posts on there. They're all free and you will love them. Okay, so that was me at New York at Bloomberg in Manhattan doing a broadcast there. And anyway, yeah, looking very smiley. Oh, look at him. That's a good one, but yeah. Anyway, there'll be a whole bunch. I put a collection here of all my favorite Warren Buffett videos in just 3 minutes. That's me in Nashville. That's him wherever he was. I'm not interviewing him. It's a split screen. 3 minutes in total for all my favorite Warren Buffett videos, and that's on my LinkedIn. That's all at alpeshpatel.com/links. Okay, so if you want to know that. Connection on LinkedIn. Does this link still work if we want to watch again? It will work later. It will work later. It's alpeshpatel.com. I'll tell you what it is. So once this webinar ends, you'll be able to use this thing. Now you might say there's a lot of links, Alpesh. Okay, the only one you ever need is this one, because everything is on this one, alpeshpatel.com/links. Okay, that's the only one you need, because it'll say my latest webinar, okay, which will become this one after this is finished, and in sort of half an hour after it's finished. There's a great free investment course for those who'd like it. You can submit your pension review, free copy of my book, LinkedIn, Daily Telegram, TV appearances, pension, all sorts of stuff, okay, all on there as well. So do have a look. Oh, and reviews on the wall. I've got a wall of love reviews as well, which people have sent in from various sources. So that's all very nice as well. I absolutely love all of this stuff. Let me just see if there's any other questions. If there are not, I shall get going. Thank you. Yeah, I think that's it. Listen, thanks everybody, and thanks for being on. Really appreciate it. And yeah, that's it from me. Submit any questions if you wish as well. And I look forward to speaking to you all at some point. So do feel free to send links and so on. Thank you all. Just go through some of the charts, just see if there's anything. I think for those who might have missed the early one, this one's a good one to re-show you. Oops, I'll blow that up again. There we go. Oh, no, that's not it. Go back, there it is. That one and this one. You can take pictures of it if you wish. Now, I don't want any of my clients getting jealous that, why is he showing this to people? Well, no, you guys get actually the all the stuff, so don't worry. Okay. Thank you all. Fantastic.